Welcome to the Financial Stuff I Wish I Knew video series. The purpose of this video project, in short, is if Mr. Elliot had children, this is what he would have tried to teach them over the decades, but compressed into a short amount of time. David is not proficient at public speaking nor photogenic. Therefore, he compiled the following information into PowerPoint presentations, wrote scripts, and using HeyGen AI, combined it all into the final project you see today. The purpose of this video series is to create an introductory awareness into financial management of personal and business pursuits and the preservation of assets, to spark ideas, and if desired, ways to create additional income that can be passive, semi-passive, and residual or semi-residual for the purpose of securing and solidifying a future of your own making. This is not a get-rich-quick scheme. I am not advocating financial success so you can have ritzy things and become snobbish or cruel. You can create wealth while being responsible, kind-hearted, and modest. You get to choose how you behave regardless of your financial situation. The Bible says, "The love of money is the root of all evil." 1 Timothy 6:10. Money can be misused just as anything else. Note, this passage says, "The love of money is the root of all evil," not money in and of itself. While some parts of this series will be analytical and considering risk, this is not intended to create fear. With regard to politics, some topics will be in historical context. I am not necessarily taking sides in this video series, but I may express concerns of confirmation bias, shrill and entrenchment that can hold us back from a more secure financial future. I cannot keep all of the topics in this video series current due to ever-changing legislation, regulation, and business conditions. You should conduct further research on your own. I am not a financial advisor nor an expert on these topics. Consult a tax professional, insurance agent, certified financial advisor or planner, etc., before proceeding to make changes in your financial life. It's up to you to filter out junk, noise, and hype so as to see the truth which can be buried in fear. Remember, you have two choices. You can make a living or you can design a life. Jim Rohn. We will now cover a few topics in this first video. Part 1, Financial Foundations. Understanding money, the basics they never taught us. The first topic is financial concepts. Then we will discuss the value of a dollar. Next, inflation, and we will end part 1 on the basics of how the banking system works. Financial concepts. Net worth is a measure of your financial health. To calculate this, take your total assets and minus your total debt. This equals your net worth. Inflation is the sustained increase in the price of goods and services. As prices rise, people afford less and less. The average rate of inflation since 1915 is 3.3%. Liquidity is how accessible your money is. Cash is the most liquid form money can be because it's easily accessible. Real estate, retirement accounts, and tangible assets such as these are less liquid because it takes time to convert them into cash. A bull market is a market that is on the rise. Prices of shares in the stock market are increasing. A bull market usually indicates the economy is good. A bear market. This is the opposite of a bull market. Share prices are decreasing. The economy is in decline and unemployment levels are rising. Emotional risk tolerance. Emotional risk tolerance is how emotionally comfortable you are with swings from bull to bear markets. Financial risk tolerance depends on your age, future earning potential, assets, etc. Asset allocation and diversification. Asset allocation is where you keep your money. Diversification is spreading out your money and assets into various baskets. Interest. Interest is a percentage type of fee applied to loans or earnings on certain investments or debt. Most interest is calculated as APR, which is annual percentage rate. Compound interest is interest that is earned on a rolling balance, not only the initial principal. You can think of it as interest earned on previously earned interest. Next, we'll talk about the value of a dollar. Here we can see a dollar in 1995. It would take $1.84 in the year 2022 to buy the same things in 1995. Over the same period of time, your buying power has dropped. This chart shows this concept in a different way. That same dollar in 1995 has the buying power of 51 cents in 2022. In this chart, you can see the inflation rate year over year, from 1995 to 2022. This is a common style of chart that you might see in financial news. However, it can be confusing. Let us look closer. The inflation rate in 2007 was 4.1%, and the following year in 2008, the inflation rate was 0.1%. Many people might say, the rate of inflation fell, which is technically true, but many observers may interpret this as prices falling. This is not correct. The style of this chart can be misinterpreted to mean that it is showing periods of price decreases. In the context of this chart, this is not what happened. Let's look at the same data in a different style of chart. This is a waterfall chart and may better represent what is happening. Here you can see in the year 2007, the inflation rate was 4.1%. The following year, the inflation rate was 0.1%. That 0.1% was on top of the previous year. For 2009, the inflation rate was 2.7%. That is 2.7% on top of the prior year, and so on. Consider the inflation rate as the speed of which prices are rising. If prices actually do fall, you will see a minus sign in front of the numbers. This is called deflation or negative inflation. Now, we will briefly discuss how the banking system works. In most governments, a central bank exists. In the United States, this is called the Federal Reserve, or the Fed for short. The Fed loans money to banks and credit unions, and those banks loan money to you and me. The Fed charges those banks interest, and then those banks charge us interest on loans made to us. We, as depositors, also deposit money in the banks, and they loan our money out as well. In late 2007 through 2009 occurred the Great Financial Crisis, also known as the subprime mortgage crisis. In summary, it was caused by risky loans and falling house prices during the same period of time. Many banks failed during this era. Regulation was enacted to prevent a repeat of this crisis. As a result, the Federal Reserve periodically conducts stress tests on large banks. Deposits in U.S. banks are insured up to $250,000 per account by the FDIC, which is the Federal Deposit Insurance Corporation. They were previously insured up to $100,000. To be clear, this insurance covers your money in the event of a bank failure. FDIC does not provide coverage in the event of fraud or scams. Now, let's look at some historical charts. The gray vertical bars are times of a confirmed recession. You can see the unemployment rate spikes during recessions and gradually returns to normal afterwards. As you can see, on the right, in the Great Financial Crisis, the unemployment rate hit 10%. Next, you can see the unemployment rate skyrocketing to 15% during the COVID pandemic. This chart shows a zoomed-in view slightly before, during, and shortly after the COVID pandemic. Unemployment surged past 10% to 15%. Now, let's look at bank failures. Here, you can see the quantity of bank failures in pink and the assets in dollars that were subject to those bank failures in blue. During the pandemic of 2020, there were minimal bank failures. This is evidence. The legislation and regulation after the Great Financial Crisis have strengthened America's banking industry. In 2023, you can see a spike in assets when only 5 banks failed. One of these banks happened to be a large bank in California, known as Silicon Valley Bank. This just happened to be the first bank failures that occurred due to a social media-ignited run on banks. Rumors and fear spread rapidly during that event in 2023. You could say it went viral and many depositors, out of fear, withdrew their money electronically in a short period of time. However, the federal government insured deposits even above the $250,000 threshold by the FDIC. This calmed fears, sustained confidence in the banking system, and prevented further bank failures. You can rest assured that your money is safe in America's banks and credit unions. Stay tuned for Part 2, Budgeting Debt and Insurance.